This is a Stock Trading Reality Podcast, episode 140.
Finding those kind of plays, doing them often, and staying small.
This is the Stock Trading Reality Podcast, where you get to see the realistic side of a trader's journey. Get inspired and stay motivated by everyday normal people who are currently on their journey to trading success. Own a donut shop? Send me a sample. I'll review it publicly. Play trader.
Yeah, absolutely. If you're looking to do some ninja marketing, and I guess there will be a small cost, but if you want to send me a donut because you own a donut shop, then please do it. I will gladly review it, not only on the podcast, I will do like a YouTube video about it. That's how much I like donuts. And I know there's all sorts of crazy stuff out there that people can do with donuts. So yeah, for sure, if you just happen to be a donut shop owner listening to this, mail me a donut, and I'm going to actually cut it in half. Mail one to Michigan, mail the other to Denver, and then, Ches, we can talk about it. Because I know, Ches, you're not quite as much of a psycho as I am when it comes to donuts, but you like yourself a donut, right?
Oh, I absolutely do, especially when I travel. I always try to go to different little small places that are highly rated. But, speaking of donuts, at our last meetup after I had flown a red-eye flight, I remember going in your room and I asked if I could have a coffee.
Right.
And you had some donuts, and I thought you were going to bite my arm off for eating your donuts. And you're like, oh, I guess they're from yesterday. You can have one if you want one. And I was like, wow, he really likes his donuts. Very, very protective of them. But yes, you did have donuts in Nashville. That was for sure.
Yeah, that's right. And the one that I did give you in Columbus, that's the one that fell into the wastebasket. So I was like, fine, you can have that one because it's a day old and it was in the wastebasket for a little bit. But yeah, but that good memory. I totally forgot about that.
I survived,
but that is true.
I survived. Yeah,
that is true. Yeah. Well, you survived. You only have 3 fingers left now because I bit off 2 of them. But that's all right. Yep. That's why we have 5 fingers to start with. So yeah, good times. The memories. So today we have another welcome back interview, and we were talking with Kris. He goes by gocubsgo in the chat room, and if you've spent really any amount of time in the chat room, then you know that he is a member that's been around for a long time. I kind of reminisce with him a little bit in terms of the earlier days of Clay Trading University and the live webinars, and he's been around since literally almost the get-go, not quite, an original 300, but he's been around a long time, and I'm sure many of you, assuming you're a member of the community, have interacted with him. He's gone through a lot. He's got an awesome system now. He's doing some great things. And when you just hear him speak, you can tell he's got the pieces in place. With that being said, if you feel overwhelmed, don't feel overwhelmed. I want you to use this as kind of a motivation tool. Motivation tool how? Well, just where you can go. It's not like Kris started off talking like this. It's not like Kris started off with all this understanding. This is what happens with hard work, blood, sweat, and tears, and dedication is you can gain understandings, you can gain strategies and systems, and present them in the way that Kris is. So don't take it as I have no idea what's going on, click off. Just say, like, wow, this is what's possible out there with the right work ethic. I mean, that's fair, right, Ches? I mean, I think that's a good way that maybe a newer trader can listen to this is just, sure, they're not going to understand every little thing, but at least they have kind of, looking into the future in terms of what is possible. That's fair, right?
Absolutely. And, another thing, too, is that, this is the one person probably, I think, out of all of our members who has picked a strategy from 2 years ago. And I'm talking about he might have just started 2 years ago, but he's stuck with it, and he's just been fine-tuning it ever since. And it's been, we've seen his performance in the chat room is just absolutely awesome. So, yeah, no, it's by no means an overnight thing. This has taken lots of, sweat and tears and lots of long hours. So, but it's a testament that it works. Yeah,
and you just got to keep that axe to the grindstone. So without further ado, it's kind of a dual interview because gocubsgo, Kris, his dog chimes in a couple of times, but that's all right. We are pet friendly here. Ches has a dog. IT Nate, the show producer, has a dog. Cubs has a dog, so not a big deal. But Kris is okay at all times. He's not being mauled. That is just his buddy that's hanging out with him tonight. So without further ado, let's welcome back Kris and hear about everything that he's been through. Cubs, welcome back to the show.
Thanks for having me. Glad to be back.
Now, I have your, I was actually, did my homework a little bit. Last time Cubs was on, for you listeners out there, was episode 27. and right now this is episode 140. So literally 2 years ago is when we last talked to Cubs, and the best part about all that is Cubs is still in the market. He's not only surviving, he's doing very well. But 2 years, that's a long time when, this, world of trading spits people out. I guess chews them up first and then spits them out all the time. And looking at the title of your podcast, it was Finding Your Groove as a Younger Trader. So you're literally 2 years older now. And on that note, before I forget, congratulations on the engagement.
Oh, thank you.
And I feel like you have, but I can't keep everything straight. Do you have a date set yet?
Yeah, it's going to be September 15th of next year. We got the church venue, got a band, so I think we're ahead of the game.
You said September 15th?
Yep.
Okay, I'm going to need you to do something. Let's just move that back to September 16th, and then we'll have the same exact wedding anniversary. So if you can pull that off,
well,
I'm sure your bride will be like, hey, this dude on the internet wants me to move our day back one day. I'm sure she'll understand.
I don't think the venue
engagement called off.
Yeah. Exactly. So, but so congratulations on that. And September, good time of year. Is it going to be in Chicago?
Yeah, it's going to be in the suburbs. We were thinking about having it downtown, but with family and stuff, parking and all that, it'd be kind of a lot. So it's going to be in the suburbs, my hometown. So hopefully it's nice weather.
I know a guy that knows how to coordinate all that stuff. If you're wondering, so that was Ches. That was, for listeners' context, I went to Chez's wedding in downtown Chicago. And just the parking thing in and of itself, that had to have been a logistical triumph, I would call it.
Logistical nightmare to start, but logistical triumph in the end. But yes, it was something we definitely had to kind of think about, and definitely cost a couple shillings to kind of pull it off so that people could, make it down there in time. But yes, I think Cubs is going to be a little bit less stress. I'm not saying there won't be any stress, because planning a wedding is always stressful regardless. But you should be in a little bit of a better situation, not having to worry about that kind of stuff.
Nothing that a couple IPAs can't fix.
There you go.
That's
exactly.
Right. That's right.
Yep. And I forget, you like your craft beers. You've been to, I know, Grand Rapids at least once, and you were asking me some places to go to. So that's right. You like IPAs. You're right. That will do wonders. So I guess starting off, like I said, 2 years ago. So I don't expect you to nail it perfectly, but kind of walk us through in a nutshell, summary format, what got you into the markets, where you went, and then ballpark it. The last time we spoke, kind of where we left things off at that point in time.
All right, let's see. Probably a junior in college when I was 20, 21, right? So started trading then a little bit, more investing. Buying dividend stocks, holding those long-term, just collecting dividends, kind of just getting my feet wet with that. Around that same time, the whole penny stock, boom was happening. So obviously, being someone young and seeing those kind of returns got my, interest sparked. So dabbled into that, made some money, lost just as much as I made. So that was probably until I was 22, 23. And then, I think right around the time that I did that podcast was kind of, finding my groove with options. Before, I would do more directional, trying to, watch a 2-minute chart, try to play a breakout, or short a short a cliff point, or when support's broken. Kind of had a hard time with that, working full time. Kind of hard to do when you got a bunch of colleagues around you. You can't really have your chart up at all times, so kind of frustrating. I'm someone who wants to succeed and be a winner and very competitive. So trying to find my groove that way, and kind of learn the other side of options, where selling premium, and learning how the probabilities are baked into an option chain, kind of what to look at. And I think when I did that podcast 2 years ago, that was right around that time when I was trying to just getting into the groove of that, kind of getting my feet wet there, selling premium. And since then, it kind of just took off. Just it's one thing to learn the basics, but then once you get comfortable, it's just all about learning efficiencies and small tweaks. Changing the littlest thing. There's this good quote out there. I'm probably gonna mess it up, but it's like, if Shaquille O'Neal made one extra free throw game, instead of being like top 20, he'd be almost top 10 in scoring. So it's just like those little tweaks that you can do.
Yeah, that's good stuff there. That's a good way to.
It's probably not the exact
perspective.
It's not the exact rankings, but it's to that point where you do small little changes, and over the long run and repetition of doing that small little change, it's to make a big impact in your portfolio. So, so that's where I'm at kind of now. Just still learning stuff, finding what works, what doesn't. But it's definitely drill down and selling premium. That's what I focus on. Making swing trades out of that. At the very most, I'm looking at a 5-minute chart, sometimes a daily chart, or usually a daily chart when I'm entering trades and whatnot. But the days of watching a 2-minute chart all day are long gone, and it's much less stressful.
Yeah, I can definitely attest to that, being kind of on the selling side of options as well. It's just a much more laid back kind of approach, but it's by no means less profitable. It's still plenty of profits to be made. But Clay, correct me if I'm wrong, Kris is probably the only person we have interviewed that has almost stuck with this same exact strategy for pretty much 2 straight years. First off, we rarely go 2 full years in a gap between re-interviewing somebody. Usually it's a year and a half. But Kris kind of was selling premium when we interviewed him then. He was just kind of getting into it. But he's one of those persons where shiny objects never kind of flashed before him, and he didn't say, I'm going to start trading futures or anything like that. He just kind of stuck with selling options premiums. And I think it's pretty telling, the fact that he's focusing on small tweaks that can kind of make big improvements to his strategy. I don't know. Am I wrong in thinking that? I don't think many people have kind of stuck to the same strategy for 2 straight years.
I was actually not thinking that, but now that you bring it up, that is very, very accurate. And I guess just for a little bit more context for listeners, Cubs, I'll just say you have some restrictions on your trading, and I'll just leave it at that.
Yeah.
And I did the day trading, did that also affect that when you were trying to do the cliff points and shorting, looking at 2-minute charts? What was those restrictions influencing all that stuff too at the time?
So that was like my first job out of school, where I was kind of doing more of the day trading. Then I quickly learned from our compliance department that that kind of trading will not be allowed. I think that's another reason why I don't go to the hottest trend. Like, Bitcoin looks really interesting, but I don't even think we can get approved to trade that at my work. But so I get 60 trades a quarter, and that definitely makes me disciplined in choosing trades I think have a high probability of success, or it can also be cumbersome a lot of the time too. Like at the end of the quarter, when I'm almost at 60 trades, it's like, oh, I want to do this, I want to roll these in the next month, but I got to wait a week, or I only got 5 trades left. I got to really think about what I want to do here. So I couldn't even day trade right now if I wanted to. It'd be 60 trades in a quarter, which you can't do off day trade. That's probably almost not even a week of day trading.
Right. So it was almost a double whammy, because to your point, I want to call that an excuse at all. I would call that a very factual reality. At a day job, some day jobs you can't be sitting there shorting the cliff point on the 2-minute chart and then being able to day trade. So not only from your job setting, but also just the compliance issues. Yeah, that makes perfect sense on why you needed to go to another format. But to Chez's point, yeah, that was 2 years ago when that all happened, and then here you are still selling premium. Now, way back then, I guess what was your premium strategies? Because like you said, you've been looking how to make that extra free throw, but when you first got started in premium selling, kind of what was your tactics? What was your approach? Because I know a lot of it's changed, but kind of where did it all start for you in terms of that premium selling?
Probably very risk averse, like selling something that only collected 20 cents or 15 cents in premium. When if something like that goes against you, it's it's not going to be good. You're not collecting enough premium to kind of lower your break even from your strike price. I guess it was looking at something that was way out of the money. Which works a lot of the time, but you eat like a bird and poop like an elephant, right? And then one bad trade can wipe out a lot of stuff. I guess taking losses almost right away. So it went against me, not really giving it time to work out. I guess just like the basics. Looking at support, which I still do, and selling maybe a put that was way more out of the money. Whereas now, I would be a little bit more aggressive, maybe $1 or, 1 strike lower than a 50-day moving average, getting a little bit more aggressive, trying to collect some more premium, sticking in trades longer now, short a put, if it goes against me, try to work my way out of it by, maybe selling a call spread or a call, collecting as much premium as I can, whereas then, I wasn't as sophisticated in all the kind of strategies and all how it kind of worked out, or, the efficiency of, how many days you should be entering some of these trades till expiration and the strike price you're selling. or when to roll, optimal premium to collect like on a call spread, or I mean you can get down to the nitty gritty about all of it. This is off the top of my head, but it was very just more casual, not thinking about the actual statistics or the math behind some of the stuff that you're doing.
Well, that brings up a good point, too, because you kind of talked about how you were, and I don't know if this is the right way to put it, much more risk-averse in the beginning, probably because you just didn't know better and didn't know kind of where exactly you'd kind of fall and where you'd like to be. Whereas now, obviously you've taken more premium. Essentially, you pretty much nail in the sense of you are just more aggressive in your trades. You know how to manage them. But I think that's kind of the cool thing about trading options, especially from the short side, is that you can literally curtail your trades so that when you put a trade on, you say, I know I have a 90% of being right every single time. Now, your profits are definitely going to be smaller than Cubs, who might be taking like a 60% chance or 65% chance, but he's letting the numbers kind of play out. And that's what I always found absolutely fascinating, is that you can literally tailor the trading to be, a little bit more risk-seeking, and especially if you know how to manage them when they go against you, or you could be completely, I'd like to be, right 95% of the time. You have those kind of options, and it's funny that they are options too. But yeah, you definitely have kind of more choices, and we've seen in our members as well. I was trading probably 70% to 85% kind of probability of success trades. Alex was taking trades that were even less riskier than that, and it's just cool the kind of customization you can do in that sense. And is it fair to say that you get to kind of be more creative in terms of if you want to get long, you could do it a couple different ways, or depending on your game plan?
Yeah, definitely. I mean, you can be selling spreads or iron condors. A skewed iron condor, which is like selling a closer to being in the money put spread and a further out of the money call spread, because you're taking more of a bullish stance. There's definitely a lot of different ways you can do it. A lot of different ways you can actually manage a trade. One thing to add though to your previous guys' points, back then, I was so scared to get a science stock, like, oh my god, this is gonna be the worst thing ever. But now a lot of times, that's one of my strategies. Is, on something I really like that pays a nice dividend, I'll sell out of the money put. And if it comes into money, that's fine. That was my game plan. It's going to be more of a longer-term hold where, I'd love to have 100 shares at that strike price and, just start selling covered calls against it and see where it takes me. It pays a 5% dividend. That's fine. I like the stock, right now I like it even $2 lower, so I'll sell a put $2 lower. So you're not always going to get a the stock, but at least you'll get the premium.
Yeah, I was actually just I want to get more into that. Because that makes a whole lot of sense to me. So you actually took the question right out of my mouth. I was going to ask you how much further below are you usually selling those puts, but usually right around a couple dollars.
Sorry if you heard my dog. It's usually the 30 delta strike. Having a I guess it'd be 30 to 40 delta, depending on how much I really want the stock or how much premium there is in it. The 30 delta meaning it's a 70% chance that it's going to be profitable at some point, 30% chance that, it's going to, be in the money. So I usually stick to, 30 to 40 deltas on plays like that where I don't mind taking stock at that strike price. Whereas if I'm just selling like a naked put on something that has high implied volatility, I'll probably stick to more of the 25 to 20 deltas.
Okay, so my follow-up question would be, for these stocks, what is the criteria for the stock itself? Are you just looking for example, 5% or more on the dividend, or are there any other criteria that factor into what stocks you would deem worthy of not minding, holding 100 shares of them?
It's kind of pretty random and a lot of different things that I look at. Can't really write a rule around, I guess. I'll look at first if, I always have a screen open that, on finviz.com, that just, the free one that just scans for anything that's oversold, RSI below 30. And, a couple weeks ago, I think GE was, a 30 RSI. So I initiated a trade on that. GE, I feel like is a pretty solid company to hold long term. The dividend was right around 4% at that time. So I put on a play on that one. I think Verizon was also put like that a couple months ago before it shot back up. Other times, it's just kind of looking at stuff that has, a nice uptrend. Maybe doesn't even pay a dividend. And, it's just like a momentum kind of stock. Looking at maybe like IBD 50 for, some ideas. Something that has a nice uptrend that maybe has a pullback to the 50-day moving average. Just something to put around there. Nothing big, it's just like, one to two contracts, 100 to 200 shares depending on the price of the stock. I feel like I'd rather spread my money out, a lot wider for you won't be making as much money, but, if something goes against you, your risk isn't that big. You can sleep fine at night knowing that, it's a small size trade relative to your account. It's just, finding those kind of plays, doing them often and staying small, and just trying to build a highly, uncorrelated account to all your holdings. It's not like I'm, going 90% into tech stocks and, wondering why I'm doing bad if, the NASDAQ has a bad day.
Right. So, and then, that's just kind of, being spread across, a lot of different stuff. But you kind of bring up a good point because I know where you primarily kind of learned a lot of these strategies, and I know how adamant they are that charts play absolutely nothing at all in kind of setting up their trades and making trades. However, you're talking about trends, you're talking about RSI, you're talking about the 50-day moving average. How much would you say charts actually still weigh in on your trading strategy, or are you still kind of, I guess if you'd have to weigh out how much percentage weight are you giving towards the options chain and the probabilities built in there, and how much weight are you giving to kind of some things you're seeing on the chart? What percentage of those kind of play into your trades?
I think it's probably maybe 70-30, 70, on the options chain, maybe 30 on the chart. Like, if a chart has a beautiful uptrend, you're only going to be collecting, 30 cents on a $80 stock with a 30 delta. It's not really worth it to me. It looks like a good stock, but that's not something I'm going to play. Whereas, like, maybe something hasn't had, like, the greatest long-term trend, but still has, a super high implied volatility rank, and I can, get maybe a strike that's 20% out of the money that expires in a month. I'll go after that. But, I would be lying if I said I didn't always open a chart and, at least look at, get some ideas of what a support or resistance line would be to be selling options, just out of there. But, it could even be like 50-50, I guess, really want to get down to it. But it's definitely, the option chain has to be good, even though the chart's good. The option chain still has to be good. You still have to be collecting premium. You're selling sometimes, for me, mostly naked options. It has to be worth my while,
Right, and that's I like how Ches kind of set that up, and I like how you just answered it. Even if it's is 70-30. Some people out there are preaching literally, if you want to do options trading, the way, and just use the numbers, use the stats. You don't need to look at a chart at all. Just look at the stats. But, and this is why we say it all the time, and Cubs is a walking proof of this, there is no holy grail strategy out there. Cubs is clearly using technical analysis along with, fundamental analysis in the sense of, option stuff, not fundamental. He's not looking at balance sheets, but he's not using just strictly charts. He's not using just strictly options, where some people may preach only charts. Some people may preach, only options chain. So perfect example. If you're out there looking for the holy grail, it does not exist. Now, you mentioned the word option. You mentioned the word naked. And for listeners, if you're not familiar, naked options is, it can be scary because theoretically the risk is unlimited. You can blow up your account and you're living under a bridge and all that sort of good stuff. But my question here is, Cubs, how have you accomplished I like how you put that earlier, being able to sleep at night? What did you have to play any mind tricks on yourself? But from a psychology level, how do you just not bite off all your fingernails when you are taking trades that have theoretical unlimited risk?
I don't know. I think it's just, about repetition where, when I first started it, I was selling puts on stuff and it go way against me and, having to keep rolling and rolling. It gets pretty aggravating, but then once you start to do it long enough, you start to see that, you can really defend yourself out of these trades, and it's just a matter of time, really. You start small. It's like a small position, and you give yourself the opportunity to, increase size if you really want to. That's kind of, the last choice that I really do. It has to be doing pretty bad to have to increase size. When you roll down further out of the money too, you're assuming you don't increase your size, your margin requirements goes down. You're lowering your break even, and a lot of the stocks that I'm playing, they're established or have some kind of momentum in them. I really don't do naked options on earnings. For every 10 you win, you have one bad loser that wipes it all out. I'm not really taking those kind of risk. Once in a while, I'll get sucked into the old binary event, kind of trade. But it's just, I think it's about repetition, knowing the tools that you can use to defend yourself, and really it's just staying small. Staying small and doing it often. I think that's probably the biggest thing that people get in trouble with is trading way too big, not knowing the notional amount of the stock that they're actually using. like selling 100 share or selling one option on $100 stock. That's a $10,000 notional. You start selling 5 of those, you better have $50K in margin to we won't accept stock. So I really don't put on trades where I know I can't afford to take the actual stock if need be. But yeah, I think it's just staying small, doing it often, and knowing your notional risk.
And and for context too and I think a lot of people especially so returns on selling options premiums can be drastically different. Like I said, it also depends on how much you're willing to risk, and like Cubs was talking about the notional and all of that stuff. But here's the problem: most people, and I'm speaking from experience, will trade too large, essentially putting 30, 40, 50% of their account on one trade, and then when it goes wrong, first off, you don't really have any capital to either add size, and you might be in a position where it actually is very, very slim chance that you are going to roll this to kind of defend it. So correct me if I'm wrong here. You like to keep it small in the sense of, I guess, how many positions generally do you carry? Because I got a follow-up question after that too.
I have to log in, but I probably have at least 20 different underlines on right now. It's probably 20 to 30, on average. We're at such low volatility right now. It's probably on the lower end, maybe 20.
I was actually going to bring that up too. So, and in terms of your capital deployment, how much cash are you sitting on in terms of percent?
I like to keep it around probably 50 to 40% cash, or having that kind of balance, available to trade on. I'd say at least 50%. Yeah.
So for context for listeners out there, he is keeping his trade small enough that he has 20 or more underlyings that he's trading. He's got 50% cash set on the side. So he has the ability, if anything was to go completely just bonkers and nuts, he's got plenty of capital not only to work out of it, and that's taught in various different ways. There's many different ways to kind of defend positions. But I know this personally just because we've talked in the chat before. What was the longest amount of time you've had to roll a trade essentially to be right? This is just one of the management techniques that you can do to kind of work your way out of a loser. I'm going to guess that it's GoPro, but I could be wrong here.
Man, yeah. Luckily, something like that hasn't happened in a while. Yeah, probably I think it was GoPro and Fitbit, and I think there's another one. I think when maybe it was Solar City before they got acquired by Tesla. I think when they were falling apart, I probably rolled those. The longest one was probably, I don't know, close to a year. Probably Fitbit. I mean, that thing hasn't had really an uptick since it was an IPO.
It's freaking true. Fitbit, goodness.
But yeah, going through one of those and coming out actually making money, that's a good confidence builder, and a good testament to know that if you stick with it long enough, you stay you be reasonable about it, not increasing your size. Where it's 75% of your account, but keep rolling, and maybe I didn't do it then, but I probably should have, knowing now, like maybe selling a call spread against all the puts that you have. I mean, I would choose a call spread now because I've been in a position where I'm rolling my puts down, and I decided to sell a naked call, make it like a strangle, and then it blows past your call. You kind of get double whammy. You were long, and now you're short.
I've done that.
Yeah,
yep,
that's the most aggravating thing. So now I kind of just stick with the call spread. I limit my risk to the upside in case it does have like a crazy bounce or some kind of news comes out, just so you don't get double whammied, I guess, going to the downside and upside. But
and I have been double whammied, and it is annoying, but this is just kind of part of the learning curve in the sense of what I really want to bring up though is that even though he was in a trade for a year, I think GoPro was 9 months, so obviously Fitbit, but Fitbit was just an absolute nasty since IPO.
The thing is, it's a turd slowly going down the toilet. That's what Fitbit is.
Yeah.
And this is different than kind of buying stock and just holding it and hoping it goes right. You are actively collecting, and I don't really know how to explain it best in kind of a short period of time. But anyways, it's not just buying and holding until you're right, but in a sense it kind of is.
It's I guess it's
the
like
thing is,
you're being paid. You're paying yourself to wait.
you're lowering your cost
Right.
base every month or every 30 to 40
Exactly.
days. You're lowering your cost base a little bit and a little bit and a little bit. And over time, that's going to add up.
And it adds up, and then you get to the point where, like you said, after a year, it's just like, I actually made a profit on that. And correct me if I'm wrong, you would say it's more annoying than anything, right? It's just aggravating.
Yeah, once I'm out of those kind of trades, it gets deleted from the watch list in perpetuity.
And the reason why I want to bring that up is that here's the thing: most people who get into trading have zero patience, and I mean zero patience. Like
so true.
trade the 1 minute chart. Clay, you're a great example, but you kind of do well with it. Like you can't sit in a trade for more than like 6 minutes at a time, or you're ready to like pull your hair out. So, and there's nothing wrong with that. This is all about everybody's personalities and stuff like that.
I'll pick you up. But
Go
Cubs
ahead.
is a total freak of nature because here Cubs is coming from penny stocks, and penny stocks is like the epitome of I have no patience because I just want to get like wise and stuff moving.
Get rich in 2 days, and then it goes
and now
dead. Yeah.
Here's Cubs doing like the exact opposite. So sorry to cut you off, but that's a good point on your part.
No, but what I want to remind people, though, is I am also part of the problem in terms of I have no patience. So here's the thing. Every options trade I have ever taken, and I'm not even kidding, every single options trade I've ever taken, I have rolled generally 2 or 3 times if they've gone against me. Now, here's the thing. If I had continued to roll them, listen very closely. If I had continued to roll them, all of them would have been profitable. It's generally when I decide I'm sick of this, I'm tired of being tied up in this, and I'm just annoyed generally, and I stop rolling it and just book the loss. It's that next cycle, and a cycle can be determined in like 30 to 60 days, depending on how you trade. The next cycle would have totally, went from a losing trade to a winning trade. So that's kind of the thing, is that I'm a part of the problem in terms of I had no patience. But Kris right here is a great example that it took a year, but he got out of a stock that's pretty much only downticked since inception. And I mean, that's a pretty rough, brutal thing to be kind of short options against. But here's the thing. After a year, after collecting a bunch of premium and a bunch of selling sucker bets the whole way down, he eventually had a profitable trade out of it. So that's the thing. It's you got to kind of be patient, and if you really let the numbers and kind of strategies play out for you, I mean, it's got just a super high hit rate. But every single one I've ever decided to stop rolling has always gone back in my favor in the next cycle, and I always want to just slap myself and bang my head against the desk when that happens.
And what you're saying for listeners, Ches, is had you just kept up with what your system and what the strategy was, it would have worked out fine. But it was the emotion of annoyance that just wrecked everything.
Made me act irrationally. Exactly.
Yeah. Okay. So now, which kind of segues into my question: How did you fight off the voices that Ches just described, Kris? So I mean, I'm stuck in here. You're annoyed. These double whammies, all these sort of things. How did you stick to the plan? I mean, what?
A lot of
What
times.
was the? Are you waving your finger in front of your mind, or you're playing Jedi mind tricks on yourself?
No,
But
a lot of times just taking a lap around the office and thinking it through. Getting back to reality.
thinking it through. Dive into that. What are you thinking it through? Because that sounds great as a general statement, but let's dig into that. What were you actually thinking about?
Just being rational about it. Just thinking about all my options. Instead of being wanting us to get it off my chest and throw it in the garbage. Taking the loss or something like that. It's just kind of exploring my options. Playing around with an option chain, seeing what kind of trades I can make to keep lowering my cost basis and still being reasonable about it. But I mean, I think after experience of having a couple of those come back and turning losers into winners, builds your confidence, and it's a testament to your strategy or the strategy selling premium and stuff like that. That you can turn things around. It's not the kind of trading where you're calling tops and bottoms. A lot of times I'll put on a trade and it'll be a 50% loser in a couple of days, so I didn't call the bottom the right way. But over time, the option will decay in price. It's still out of the money. It's just all extrinsic value. Data will do its job. I stay patient with that. The losers that that are out of the money that just have all extrinsic value. I'm pretty good about those. I just feel like it's almost close to common sense when you know that strategy that it's just a waiting game at that point. It's only a 30 to 40 day trade, just kind of letting the time the sand in the sand glass just kind of go to the bottom and let that option whittle away. When they kind of go below your strike price, that's when I kind of start getting more active with it. Rolling further out in time. selling the opposite side, collecting a little bit more premium. And I'm not afraid to roll it to a couple of months further on in time just to get way out of the money. Like Equifax, what is it, 2 weeks ago, where it was just so straight falling knife. I started selling puts when it was like maybe like around. I think I sold the 97.5 puts when I was like at 110. So obviously I didn't call the bottom. It's still collapsed $20 more. It bounced like around 90. But when I was in the money at 97.5, and it was at like 95, that's when I kind of started to look at it. I think I collected $1 or $2 in premium. So 97.5 minus like $2 was right around just above 95 break even. So when it got around there, I kind of explored my options, and I rolled it. I think it was until December. I rolled it down to 80 just so I didn't have to watch it as much, not pay attention to it that much. Which I guess is, I don't know if it's against the book when you're. Who knows? It's even like set rules really about it. But I wasn't afraid to roll it a couple months further on in time just so I didn't have to watch it in my everyday life. I was comfortable rolling it $15 more lower out of the money. And it's just, I guess, not being afraid to go against the norm. Just because one person says, "Oh, you always have to do 45 days. You never go further on time." Well, hey, going further on time made me comfortable, and didn't have to increase size. Just rolled it further down, so I didn't have to watch it every day and have to worry about it. So I guess it's just
okay,
like
I gotta cut you off right there because you got my adrenaline flowing. Just because I know exactly what you're getting at. Just because somebody says it's got to be 45 day, or it's got to be this, no, it doesn't have to be that. It's got to be what's going to keep you a rational human being and not have to go to the loony bin. So to Cub's point, which was beautifully said, he rolled it to what he just felt comfortable with. There's way too many people, and I'm not saying that they're a bad resource. I'm not saying that anybody's necessarily a bad resource, but sometimes people look at certain philosophies, certain groups, certain whatever you want to call it, as like the be all end all. It's got to be those numbers, and if you vary at all, it's not going to work, and you're not you're breaking. No, are they good guidelines? Yes, absolutely, but there is no such thing as a holy grail. So I love how you said that, Cubs, about are you doing it the exact 45 days? No, but you're doing it where you can keep you still have your fingernails, I would assume, right?
Yeah, yes I do.
So exactly, and that's what we're trying to do as traders, whether you're a swing trader, an options trader, a Bitcoin trader, we just want to have our fingernails, and you got to find the strategies that allow for that. So, and the other point I wanted to make real quick is when you were first getting started, Kris, you threw the words, I had to think about it. I had to make sure I was doing things that are rational. And the reason why Kris could do that in the first place is because he actually had a foundation of understanding. If you are brand new and you have no idea what you're doing, what are you going to think about? What are you going to be like, well, what's the rational thing to do right now? You don't even know what you don't even know what you're doing. So don't take Kris's what he was doing and saying, well, I remember that podcast. The guy said he would just walk around the office and think about it and think about what would be the rational choice, to do. If you are brand new, you have no idea what would be rational, what to do in any situation. So, apples and oranges there as far as what Kris is talking about compared to what, a newer trader, would be talking about. So, I guess the thing that I'm wondering about here is, I'm trying to, let's just go with the 45 days. Did you used to follow like the 45-day rule to a T? Or did you always kind of fluctuate around and kind of do your own thing?
Oh, at first I would just sell like 2 weeks out. Get 20 cents for an option that expired in 2 weeks, and like I said, you're putting way too much risk on for a little reward. But I think over time, I still kind of stick to the 45 days like an initiation out of the trade. But when it comes to management, I don't have that kind of rule or philosophy where it has to be you're only rolling to the next month on time. If I see something that even if there's only 20 days left till expiration, and you can still get decent premium for the the front month. Like I think November right now is at like 43 or some odd days till expiration, the monthlies. But if 2-3 weeks from now, if I still saw a play that I liked that expired in November, I would still play it. It has premium, and I almost would favor less time being in a trade because I could redeploy the capital. But I generally try to put a decent amount of capital on it 45 days just because, from what I've learned, a good amount of decay that starts, then you can still get a decent amount of premium. But do I stick to that all the time? No. Like, if I find a trade that has 20 days to expiration, I'll put that on. That's what I would actually prefer. Like I said, the less time I have to keep my capital in something, the better. But I don't really open up trade though. That's I would say over probably like 65 days as an opening trade. I probably wouldn't open that unless it's UVXY, which I go way out in time.
Okay, wow. I feel like this was staged. That was going to be my follow-up question. UVXY, this one is your lover. Hopefully your wife doesn't get, or your future wife doesn't get too jealous. But tell us the backstory. Where did this UVXY, because I swear that thing has been in your portfolio since almost as long as I've known you now, which has been over 2 years. So tell us about the history of UVXY.
So I think what kind of got me drawn into it was when we actually, and one day we did have a lot of volatility, and during then, like, I saw when I started like to weight my deltas in my account, I realized I am way too long in the market. My deltas are way too high relative to SPY, which that's what I weighted to, and I just saw UVXY, like, just doing research and trying to find ways to get a little bit short the market without having to put too much capital to work. I sold a couple puts on UVXY that went terribly against me. I didn't really know the product at all, how it decays, and when volatility gets lower, it really starts to decay. So I think I sold like a couple UVXY puts just to get some negative delta, because when UVXY goes up, that means there's volatility. The market's probably going down, and by selling puts, I'll be making some money when the market goes down to kind of balance out my portfolio. And once the market started to rally back, the UVXY got destroyed, and rolling puts, and then just turned them into cover calls. And I probably went on for a couple months, and I was in that every day, and selling my cover calls, every month. But during that time, I really got a good sense of how that product works, and I've been watching ever since. Kind of just watching how it reacts to volatility, contraction, and how much premium there is in those options. And not to say it's not a risky product, because it is, especially in a bear market. I think it can really explode. But I feel pretty good about the strikes that I pick, and the time I'm in it. Like the VIX is under 10 right now. I am maybe have one call that I'm short in UVXY that. It expires in, like, I think the furthest out expiration it's like 2019, but it's literally insane how much premium you can get in like the 65 strike call. I think UVXY is right around 20 right now, and you can sell like the 65 call. I think right around the $5 range, maybe $6. I haven't looked at it in a little bit, but I don't want to tempt myself to be selling calls when the VIX is this low. But when the VIX really starts to move, you can the VIX is like above 15 or 20. I've learned that odds are it's not going to stay that high for a long period of time. So I'm comfortable maybe selling when the VIX is that high, selling 2 times UVXY's current price, like that call. So say UVXY was at $30 a share, the VIX was at 20. It got up there a little bit. I would start looking at like maybe the $60 call and selling that, and I feel pretty comfortable about that, knowing that I have a pretty good shot that UVXY will contract in a pretty timely manner, UVXY and volatility. So I guess just like the screen time of watching that, and just seeing how profitable it can be. And I might have a little bit of luck right now, since we really haven't had that big of a downturn, and I realize that, which makes me not trade it that big, and makes me be pretty disciplined about when I'm entering it. And I think that's like the one product I actually have like set rules on, like not opening any trades when the VIX is like below 12 below 12, starting to take things off, and like starting to build a position when maybe the VIX is above 15, or right around there. I also watch an index called VVIX, which is volatility on volatility, which can be a mind bender for some people.
The market is so crazy. But
that can give you kind of a good gauge about, at certain points when maybe the VIX is 11, the volatility on the VIX can be, at different levels. So using that as a kind of a gauge of how expensive or how cheap, the options are in volatility products. So it's kind of, having set rules and also using a couple different resources. But what actually got me into UVXY is getting long it, which is a very hard thing to do to make money off of.
Yeah, that's definitely true. And for the listeners out there, if they didn't catch it, UVXY, his whole focus on volatility products, what would you say this makes up? Maybe 20% of your portfolio sometimes when you're kind of in it, or is it a larger part in the whole?
No,
I would say it's just one small part of your trading.
Yeah, it's just one product to me, maybe 10%, but it definitely accounts for more than 20% of my gains in my portfolio.
Yep, and you would say that's probably just the reverting nature of it generally?
Yeah, just kind of knowing, how fear is overpriced. There's a reason why when you walk into that Apple store, they want to sell you the insurance on that laptop. They know in the long run, they're going to be making money off selling that premium to their customers, or like going to a casino. They have table limits. They know in the long run they're going to be making money off you. They might have a few outlier moves, but in the long run, there's a reason why they do what they do and they're in business. It's just how the whole insurance and premium kind of relates. There's a reason why insurance companies are in business, and I feel like the premium is kind of the same way on the stock market.
And for context for listeners out there, if you have no familiarity with volatility products or the VIX or anything like that, UVXY has reverse split so many times because volatility has been so low. If you actually look at it on a daily or a weekly or a monthly chart, I think with the reverse split adjusted, it puts the price at like $100 million. And I promise you it never traded for that. So every time it gets, like Cubs was saying right now, it's trading at around $20. As soon as it decays down to like $6, $7, $8 again, they'll just do another reverse split. So it's kind of been a crazy, run for that thing. And I mean, you nailed it on the head when you said it's very hard to make money getting long that thing. You have to be, you got a maybe 5% chance generally, and the rest of the time it's just kind of downtrending. So, but yeah, that's kind of a big focus on volatility, and that's priced pretty much on how hard the market's rallying or falling, or what are we scared about. And just like you kind of said, fear pays pretty large, and it's generally overstated, which is kind of, I would venture to say, why you kind of put those trades on. But I guess if you had any... Go ahead.
No. Can I chime in, Ches? Is that okay?
Sure. It's my podcast. You can all share it.
You're such a nice guy. What I really like what Cubs said, and I just realized, remember, Cubs and Kris is the same. In my mind, I keep doing it back and forth, but it's the same person. So you made the comment, and what I liked really, what shows me how self-aware you are is, I realize some of it's, and not luck in the sense of blind luck, but just the market is acting in a very, manner right now where it's, I don't want to make these things like easy trades, but you're aware of the fact that, you got to be careful, because if the market kind of shifts its mood a little bit and doesn't just go up almost every single day, then things could, change a little bit. So I like how you're self-aware and you're not sitting there saying that you got it all figured out because this strategy is some sort of holy grail, and you have exact rules in place, because you do realize, there is a little kind of just, wow, everything's so rainbows and butterflies right now, because the market is just an absolute beast for the past, however many years it's been. So I like that in sense of being self-aware. So
yeah, once you start getting cocky, that's when you start losing money.
Yeah, exactly. And a lot of these people, and it's almost like in a bubble in a sense, but not really. But and we've talked about this before, whether it's the real estate market, the tech or the .com bubble, the marijuana penny stocks. Right now, I think some stuff's going on with Bitcoin. All these people are confusing just the bubble expansion with skill, and then they're getting cocky. So, but Kris is well aware that there's some nice things going on, but it's not like it's just pure skill. It's purely me, or anything like that. So that's good stuff there. That's good self-actualization. I don't think that's a real word. Self-awareness. I'll just leave it at that. So
self-awareness is a good way to put it.
Yeah.
But I think this is a valuable question, especially for listeners out there who have absolutely no familiarity with selling options, or they might have only heard of covered calls and how it's good for, retirement, stuff like that. But Kris, what would you say is kind of some advice? It doesn't have to be one piece of advice. What's some advice you'd give to a new listener, new trader, or something who wants to kind of get involved in selling premium? I mean, would you say that they need to be kind of long-term swing traders, or I guess what would you tell somebody who's brand new and said, "Tell me why I should sell premium"?
It doesn't take a lot of time to watch it all day. It's kind of something that you can put on and kind of maybe check maybe 3 times a day in the market open, see where you're at. Maybe around noon you want to check your positions, and towards the close, you want to make any adjustments, or if any trades need to be made, you can. It's not very time consuming. It works pretty well if you have a full-time job during the day. I feel like it's not as much stress, watching charts all day. It kind of gets you, I think, familiar with kind of what bigger institutions do, like kind of be more of a math game for them, using the probabilities of their success. But you're obviously doing it on a smaller scale. I think though it's just you don't have to be a swing trader, but if you're a day trader, you might get pretty impatient with some of the moves and be taking losses too quickly, or not being in a winner for long enough time to kind of maximize your gains over the long time. But if someone who new actually wants to do it, I would say start small, very small, get your feet wet, have a good base of how to pick a strike price you want to sell that you think's gonna be out of the money based on you can support and resistance, or using some of the indicators. Like I use RSI, and that's probably the only indicator I really use besides moving averages. Just thinking about start with like maybe Dow 30 stocks, maybe start with like a GE or Verizon or AT&T, something that's low dollars in price, and it doesn't take much margin. It won't have much swings back and forth, but you gotta be realistic. You're not gonna be making much off the premium, but at least you can start watching the options, putting some on, kind of seeing how they move closer to expiration or further out in expiration, when it goes against you or goes for you. I think the one thing to keep in mind, obviously, I leave money on the table when stocks, go my way. I have a capped upside, but the whole game plan is to do it in repetition and have lots of winners, and having those add up instead of having that one big home run ball. You're going to be leaving money on the table, but I wouldn't get discouraged with that. You're playing the odds. You're not using as much capital as if you're just buying shares.
Well said. And kind of the moral of the story here is, if you want to be the casino, then this is what Kris is. Kris is a casino. That is what he is essentially doing. He's playing the odds. He understands the math. He's got a strategy that allows him to play the probabilities. And sure, he's leaving money on the table, like he said, but at the end of the day, it's not about hitting that huge home run ball. It's about just nickel and dimes, and they add up, and they can add up actually pretty quickly, and then you can really get the snowball effect going, and that is really the name of the game. Final question before we wrap things up, and just really me asking out of curiosity, do you notice anything? I don't know if weaknesses is the right term, but maybe some things in your trading, in your psychology, in anything. But do you notice something that you've identified that you probably think, yeah, Kris, Cubs, I don't know what you call yourself in your mind, but that's something I should probably be working on, or at least be focused on it to make sure it doesn't spin out of control. Do you know? Have you got any of that stuff kind of going on right now?
Sometimes being drawn to those big binary events, like the biotech announcements, seeing how much premium there is. I think it just needs to be more disciplined about. I need to be more disciplined about just picking stocks that I don't mind holding 100 shares of, or 200, 300 shares, 400 shares of. I like the point I said, rolling too far in time. I wouldn't call it a weakness. That's just something that I prefer. I think now Equifax is back in like the 110 maybe handle, and that those puts I sold would have been fine, but I didn't really feel like dealing with it or watching it or really thinking about it that much, so I just rolled it out in time. Like I said also earlier, I need to be aware when I'm trading UVXY, how low volatility is now, and just being disciplined in my rules. But I think it's just you have to find what works, not think that you have to follow everyone else's rules to a T. You can kind of take a book out of everyone else's, a page out of everyone else's book, and kind of build your own story, and just do what works for you, makes you feel comfortable, and find what works, and then build your efficiency out of that.
That's well said. And build what works for you, and what essentially. And like I said, Kris, oh man, for you listeners, I can remember when I first started doing live webinars for Clay Trading University. Once in a while, we would do Saturday morning ones. So this is a blast from the past, and Cubs was one of those guys that was showing up on Saturday morning for a webinar. Yes, Saturday morning, I was doing live webinars, and they really weren't that popular in the sense of attendance, which I totally get. It's freaking Saturday morning. But Cubs, he was there, and he was bringing scans. He was working hard. So, fast forward over 2 years later, and he's in an awesome groove. He's doing very well. He speaks very intelligently about all this because he is intelligent about it. But just understand that there is a ton of blood, sweat, tears, and effort that went into all this. So it's not like, to go with another quote from the movie The Founder. So I don't know if this is actually, but, Ray Kroc, the guy that founded McDonald's, he said he was an overnight success, 30 years in the making. So, I mean, same concept here that, yeah, Cubs is having success, but he put in a lot of effort. And, there's a select few of people that I still remember from those Saturday morning webinars, and Cubs is one of them. He brought in scans. He interacted on a Saturday morning. So if that doesn't summarize things up enough, I don't know what does. But, yeah, Cubs, we'll definitely have to have you back again. And this was very enlightening. We've had people in the chat room. You got to talk to Cubs. I want to know what he's doing, like what exactly he's up to. So here you've gotten, a taste of it. And but at the end of the day, what is Cubs doing? He's taking general rules that you need to learn first: supports, resistances, trends, an options chain, strike prices, understanding the Greeks, and then he's putting his own little twist on it. And what he is doing exactly, so what I'm getting at is, please don't contact me or Chez. Be like, can you please have Cubs email me every little thing that he does? No, that's not how it works. You got to do what works for you. Chez, did I leave anything out, or is that a pretty good summary of kind of how people should leave this podcast?
I think you nailed it on the head.
Good. That's what I'm going. I like nails hitting on the head. Cubs, you have anything final to say before we wrap things up? Or
no, appreciate you guys having me back. Hopefully it's beneficial to the listeners. I want to help people, and I guess just know that my risk tolerance probably isn't the same as yours. And if you found anything that I said, that you want to do, I just do it small and see where it takes you, and then see if you're comfortable with it. But yeah, hopefully it helps the listeners, and they can make some money out of it.
It will for sure, and I like what you said. If you like it, start small and then go from there. And that is really no truer words could be spoken. So, Cubs, I appreciate it. Thank you for hanging out. We're recording this an evening after I know you've gotten home from work, so I appreciate you, taking time out of your day. And we will have to have you back for sure. Again, we'll try not to do it 2 years from now. That I will promise you. No, none of this 2-year stuff. But yeah, thank you for continuing to be a part of the community. It's time flies. I'll just leave it at that. So
yeah, sure
for you
does.
listeners out there, a final few things before we go. If you're listening on YouTube, make sure to click that like button and check out the channel as a whole. A lot of other videos, and hopefully you ultimately decide to subscribe. If you're listening on iTunes or any of the other podcast players, then subscribe. And most importantly, because it really does help us out, if you could leave us a rating on iTunes. Yeah, that's a very quick and efficient way to just let us know that you want us to keep making these and that you're finding value in them. And finally, if you're listening on claytrader.com, the site itself, on the show notes page, click that share button, and also feel free to leave us comments down below. We read those. We will interact. And, it's not one of these things where you just post comments and nobody ever reads them. No, we will for sure read them. So Thank you again to all of you as listeners. Thank you to Kris, a.k.a. Cubs. Thank you, as always, to our esteemed co-host, Ches. We will see you back next week.
This has been the Stock Trading Reality Podcast. Thanks for taking the time to hang out. To learn more about Clay and the Clay Trader community, including the trading team, premium training, and more, visit claytrader.com.